The toughest thing for every investor is having the discipline, both emotionally and procedurally, to do the right thing when the market is down and it becomes difficult to stick to the plan. So in today's video, we are going to go over what we call the red dot chart, which is a chart that in every single meeting we make an attempt to review with every single client. And I'll say it's on the investing front, probably the most important lessons that we try to instill in anybody. And so in today's video, we're planning on going over the red dot chart and a couple lessons that we like to pull from it. So welcome to Cup of Bull. My name is Michael Dunham. With me today is Patrick Fontana, the founder of Fontana Financial Planning.
Welcome, Michael. Cheers.
Cheers.
Welcome to Cup of Bull.
So Patrick, we'll go ahead and pull up the red dot chart on the screen here so the viewers at home can see what we are talking about. With that, why don't you go ahead and describe the gray bars to begin and the lessons that we like to go over there?
Sure. So two main things that we like to pull from this chart. The bars across, this is from 1980 until now, and the bars just simply show history, what happened with the S&P 500 every year. And these bars are all over the place. I started my career right at the middle of this chart, and the first 3 years were negative, down, 50% total, the first 3 years in the financial planning business. One lesson, the first lesson we point out here is no one knows what the next bar is going to be, right? Anything can happen each year. We don't know where it's going to end up until December 31st when the whole year is over. Anytime anyone tells you they know, like what the market's going to do, the hair should stand up on the back of your neck, and you should be a little wary that no one knows what happens year to year. So first lesson, no one knows what the next bar is going to be. Second, I think more important thing in here is what are these red dots, right? Every year there's a low point, and that's what the red dot is. So last year in April, minus 19. Every year there's a red dot. What's our advice going to be? And what's our investment policy statement? It's very simplified. And so we've gone over this with everyone, and we're going to repeat. What do we do on a red dot, Michael?
We never sell on a red dot. And so that's where the emotion comes in. And I'll also say the financial planning discipline of not putting yourself in a position where you may have to sell on a red dot because maybe you need money and you have to sell investments to come up with it. But very simplified, we never want to sell on a red dot.
So when you look at your overall allocation, the things that protect you from having to sell on a red dot is having an emergency fund or a war chest, right? So we've built more and more of those up. So, like I've got the fresh powder to not need to reach in and sell any of my investments that are down at the red dot. Second thing is, what are wise moves to do on the red dot? We've got a goal to just acknowledge and know and say out loud, like there will be red dots. That's an important thing. The second thing is do smart behaviors. The big basic one is never sell on a red dot. The more opportunistic thing, and the thing that's awesome, what we find is when there is a red dot and we have the call, hey, I see there's a red dot. Let's do something. And those are joyful calls. So what are smart things to do at the red dot from a financial planning point of view?
Yeah. So add money is the first and the easiest one that anybody can do. So if you do have cash, adding money on a red dot is helpful. I'll say that's part of the rebalancing process. So generally when we have an investment portfolio, it's not 100% equities. So generally there's some bonds, some cash, some things that historically are probably not down, or at least not down as much if we're in a down market. And so that allows us to add money through the process of rebalancing. But also if we have fresh cash, it's another way to do it. One thing that you can do with that fresh cash is if you haven't funded your tax deferred account. So like if you haven't done your Roth IRA, if you haven't funded your 401k, if you haven't funded your HSA, like various vehicles that are tax advantaged, doing that on a red dot is a way to add cash in a strategic way. And then the other thing I would bring up is Roth conversions. And so a number of our clients who have stopped working or maybe have large required distributions that will likely come down the road in the future, and Roth conversions is part of the financial plan, on a red dot is a great time to do a Roth conversion, because essentially what you're able to do is you're able to convert more shares or a larger percentage of the account for the same tax cost. So it's kind of like taking advantage of Black Friday with your Roth conversion.
Right. So smart financial planning moves, to recap: add money, do the extra contributions to your 529s, your Roths, your 401ks. And strategically, if you were going to do a Roth conversion anyway, that's a smart time to do it. So say you've got $100,000 that you're looking to convert, the market's down and it's at 80,000. You convert it to Roth, and then the market recovers, rebounds. You've done more shares, more value at that low point. So red dot chart recap: we've got two main lessons. One is nobody knows what the next bar is going to be. And when you give the investments time in the market, the longer the time frame, the more it is in your favor, right? So on a 1 year basis, making money, it's essentially 70-30. 5 years, ups to 86. 10 years, ups to 95. 20 years, it's never been down, knock on wood. But time in the market.
Yeah, and I like to, on that note, I actually like to, like if we have the red dot chart up on the screen right now, like actually taking your fingers and looking at any 5 or 10 year period, and you'll notice a couple things. One, the market is up much more often than it's down. And so historically, 3 out of every 4 years, the market's up, as Patrick said. And even though it averages 10%, so historically the return is 10%, that's not 10%, 10%, 10%, right? And so you'll notice if you look at the returns every year, there's only 1 year where it shows 10%. It was actually a little bit less than that. It was like 9.9. But as long as you give yourself a long enough time horizon, it's a reasonable expectation that the market will return roughly 10% over time, as it has done historically.
It's essentially negative one in 4 years. You can expect 10% every other year and 20%, a true bear market down a full 20 about every 5 years. So we've had a few shock events that are on this chart, and you can look at when that's happened and how it's happened. One thing I'd like to point out too is the bigger the decline, the faster the recovery. So COVID was 33% in essentially 1 month, right? And then if you look at that year where you get the big down, what did it do by the end of the year? Up significantly. So if somebody added on that red dot, that immediate year, right away, they got a huge return. So
yeah, and that's the other thing I'll point out on that is that's where it can get dangerous to wait and say like, hey, what if the market keeps going down? And that's where I'm a big fan of like, let's take what we can get as opposed to getting greedy and in case it keeps going down, because nobody's going to ring a bell at the bottom. You're never going to know. But what we do know is, hey, if the market's down 20%, if the market's down 30%, we're getting a discount compared to what we would have gotten not too long ago. In the COVID example was 19 trading days from top to bottom. And so with that, like just having the discipline, having the mentality to lean in, that's much more important than trying to ring the bell at the bottom.
We never know until after the fact, when the year's over, that is the red dot, but we do always know when we're on a red dot. So expect when we're on the red dot, a little bit of push from us to add cash to rebalance. We're going to be rebalancing every quarter, automatically taking I like to say, there's no way to buy low and sell high with just like emotion, but there is a way to buy low and sell high with discipline. And so when we hit rebalance and the stock market is on a red dot, we're taking money from fixed income and cash and adding it to equities. On the reverse side, like at the end of the year or January of this year, when we rebalanced day, we were taking money out of equities because it was at an all-time high and topping off the coffers for war chest accounts and fixed income. Good recap of the red dot chart, Michael.
How do you want to wrap us up today?
I think we should rebalance on every red dot.
Rebalance with discipline.
Cheers.